last week, just after we're done the conversation. I'll find a time to do that, okay? So let me get something else here. Okay, all right. Just in case you need to write something, you can write it right now. Okay, so we're going to continue. Just bringing up the whiteboard just to write some key things. Putting that up. Okay. So we're going to continue on. So explain the second line, second test. Again, does everybody understand the first test? Does everybody understand the first test? Does everybody need the first test done over again? We good? Okay, good. The acronyms, I guess. Okay, can you explain the acronyms again?
So gross debt service ratio is the first one.
And that one entails?
That one's basically your living costs. So the only thing they look at though for living costs is your mortgage payment, your property tax, condo fees if there are any, and usually just heating. Heating is, it just defaults usually to $100. So just add $100 for heating, whatever your condo fees are, your property tax, and whatever the mortgage amount is. So you can go to a mortgage calculator online, type in amount that you want to borrow, type in the down payment, and it kicks out the mortgage payment. You take that mortgage payment and add it to the other things, and that number, that total cannot be greater than 32% of your income.
So number one, right, is going to be 32%. 32. That sucked. 32% of gross income, correct?
That's gross income, correct.
Okay. That's not being very of gross. All right. Income. Always gross income, actually. It's always gross income, correct?
Correct. So for anybody out there that's got rental units, we'll take your rent as income.
How much of that income?
So it again depends on the lender and depends on the deal. Some lenders go 50% of the income. Some lenders will gross it up to 100%. Okay. And then income verification. Every lender has a different way of verifying income. They'll usually average your last 2 years' notice of assessments. But again, it depends on the lender. CIBC, for example, if you're a salaried employee and your pay doesn't vary more than 2% per pay, then they wouldn't even ask you for your notice of assessment. They'll just ask you for your pay stub or your EFTs, your electronic transfer through your bank account, and they'll usually just gross that up 40%. Okay, so that's a little tip for anybody who deals with financing through CIBC. Notice of assessments aren't always necessary. You've got to pay attention to what the rules are of the lender. Nowadays, they're starting to ask, more and more lenders are starting to ask for notice of assessments. But, depending on how you're paid and what your position is, it's not always the case. It's not always a requirement. So these ratios that we're talking about, the GDSR and TDSR, those are the two ratios that we look at. But there's more than just the ratios. The ratios are your starting point. So when it comes to credit, there's 5 C's, right? So the ratios basically, they're one aspect of it. They're also going to look at your credit, and your credit usually has to be over 640 for a traditional lender to approve the financing. And that score you can get off Equifax or TransUnion or whatever other credit agencies are out there. They'll look at the deal, they'll look at the character of the person, how long have they been employed, are they stable? They'll look at the collateral, how much of a down payment are you putting? Capacity is your income, right? So there's capacity, there's character, there's collateral, there's credit worthiness, right?
What's character mean?
So characters is the person himself.
Oh,
You know,
they can deny.
Have they declared bankruptcy in the
All right,
past?
right. So credit history.
Right. Is it an 18-year-old boy who's getting paid $100,000 a year from his dad's company?
Right.
You know what I mean? Things like that, right? So they'll look at, of course, they'll look at the character of the person. They'll look at the collateral, their credit score, their capacity, and the deal itself. You know, what shape is the home in? What area is it in? Things like that.
Okay, so what's the XXX assessment?
That sounds like the notice of assessment, and the XXXX is just the social insurance numbers blanked out. I think that's what you're referring to? Correct. Notice of assessment, when you do your income taxes every year and you file them, usually a month or 2 months later, the government sends you a notice of assessment. That just says that the government's received it, they verified it, there's either a balance owing to you or a balance owing to them, an amount outstanding to them. And it just basically recaps your T1 general, so the summary of your taxes. It basically itemizes a few of those points, and it's just a quick way to indicate how much you've made that year. And it usually at the bottom will tell you what RSP contribution you have, things like that. It's a recap of your year's income.
So right now, Tarek, 640 is a score that'll get you a mortgage as a credit score.
Yeah, for most lenders.
Right. What about B lenders and C lenders? Will they go below that 640 or?
Yeah, some of them will go 580, as low as 580.
Right. Of course, the interest is going to be a little bit higher.
You're going to pay a little bit of a higher interest rate.
Sure. Okay. Okay. So, any questions about working with institutions and banks? What you need to do, what you can do? Any questions there?
Just one other thing I wanted to point out. This is an inside tip. If you're doing a mortgage, and let's say the mortgage is brand new, and you also want to do a line of credit at the same time, always get the mortgage done first. Okay, but once the mortgage lender catches wind of a line of credit, it's going to make it harder, obviously, for you to get your mortgage. But if you get your mortgage approved, you've got usually 30 days before it's reflected on your credit score or on your credit statement. So technically, if you get a mortgage, you've got a 30-day window where you can kind of go out there and still get a line of credit, and they won't see that mortgage on your credit score. And I've seen many clients do that. Right?
That's good. It's important to know what the institution wants to see and what's going to make it easier for you. So the sequence of events that they want you to take, I think, is important to understand and know. And you can ask them directly. Say, is this going to affect, or how is this going to affect the underwriters, the loan, the likelihood of the loan being accepted. Concerning Justin's question of how many mortgages. Tom, can you talk a little about that? How many mortgages can an individual take on?
Once you go past 4, typically with most lenders, they're going to want to start to see you putting down a much more significant down payment. So I mean, technically, you can hold 20 mortgages if you can afford. If your income allows you to have 20 mortgages, you can have 20 mortgages.
And the dilemma and challenge is that most people come in with a mortgage that loses money. They come in with a property that loses money. So that income is counted against you, obviously, because it's not an income, it's a loss. So we want to make sure that, when we come into properties that are profiting, that's going to help us in future mortgages, right? It's just a question of the bank looking at your whole picture and saying, look, you can't afford to take on a 5th mortgage because you don't make enough money to cover the net loss or the small profit that you're making from your properties.
The 4 mortgages that I was talking about is you can have 4 residential mortgages and pay 5% down payment on all 4. Once you go past that, they're going to want to see 20% down payment because they're going to think that you're in the business. And at that point, they obviously want more skin in the game. But you can do 4 mortgages at 5% down.
Can you explain that, Tarek? Because most people understand the 5% is first-time home buyers.
No. So that 5% down payment applies to your first home, your second home, your third home. If you buy 10 homes in 10 years, that 5% down payment rule applies. As long as you pay your CMHC fees, they don't care because they get paid. It's the deal's insured.
Regardless if it's an investment property or your home.
Well, I mean, if it's an investment, I mean, it depends on what you're telling the lender, right?
Right.
So if you're buying a second home and you're letting them know it's an investment property,
Requirement's going to be different,
it's going to be different,
right? But
you're allowed to have 2 homes,
2 homes, sure.
right? There's
Sure.
nothing that says you can't. And you could buy a 3rd home for your kid if you wanted to, or
Right.
if it's for a relative, and as long as the income supports it. I mean, again, it depends on the lender. Some lenders will let you have 2 or 3. Some might say no. After one, you're getting into the rental business. You got to put down 20%.
And the lenders that you work with right now, Tar, are you working with lenders that allow up to 4 or 5%?
Yeah. So through our broker channel, there's many we call tier 2 financial institutions that let you carry 4 mortgages. On the tier 1 side, so with traditional banks, 2, sometimes 3. So I've held 2 mortgages with CIBC, and I've had friends that have held 3 mortgages with CIBC, all residential, all with 5% down.
That's kind of a limit, though.
Yeah, right? Well, yeah, and then I work for Great West Life. London Life typically has the best rates on mortgages, even better than the banks, but they're definitely the most conservative.
So, right? Vivian, that's a great question. So why should we not just say that we're buying for investment for a second property? Vivian and everyone on this call know this. You can do that. We're not going to tell you to tell them something that isn't true or accurate. That's something that you have to decide what you're comfortable with, right? We're not going to tell you to, do something deceptive. We're just telling you the rules of the game. That's all. Right? And Vivian, it's up to you, what you feel comfortable with. And if you want to tell them that it's a home for you, the second home is no big deal. The second home is no big deal because it could be anything. It could be a vacation home, could be cottage. That's not a big deal. Once you get into the third home, and not that typically there's not going to be a lot of checks, balances, and checks on that. As far as I know, there's no body that checks into that. It's really something based on you telling them what it's for.
I have a client right now that did 2 mortgages through us at London Life. So the first mortgage he bought here in London, Ontario, for him and his family. His sister moved from the States to Windsor. She had a significant down payment, but she had very bad credit and no income in Canada. So he basically did the mortgage for her on the second property through us at London Life. And when London Life asked, why is this person buying a second home? Well, it happens that he worked in Windsor, and rather than commuting, Monday to Friday, he would use that home, to stay over during the week. No questions asked. Mortgage was approved. He could afford it. The income was there. The down payment was there.
Yeah,
and it was for his sisters. So.
Yeah, and you know what? It's really for their protection more than yours, right? They're protecting themselves if they ask the question, because they can say, "Well, we asked, and they said this." So they're going to ask you that question. How you answer it is totally up to you. Tarek's just making the point that pretty much 4 with a lot of lenders. 4 is okay. 2 is definitely okay with everybody, pretty much. So how you take that and what you use it and how you take advantage of that is totally up to you. Okay, does that answer your question, Vivian?
One other thing I wanted to mention, if you're going to a Tier A chartered bank and you're applying for a mortgage or secured line of credit, and you get declined, don't get discouraged. If the numbers look right, chances are somebody will approve you. A lot of the times what ends up happening is the advisor or the mortgage person at the financial institution doesn't always have the right amount of experience. So, having worked at CIBC, our mortgage training was literally 1 day. So one day you take a course, the second day you got a license to screw up somebody's life. So until you get, 2-3 years under your belt and you've done all types of mortgages, you're not really going to know what's available out there in the marketplace.
Or how creative you can
be, right?
Yeah,
so sometimes it's a matter of finding the right mortgage broker,
totally,
or the right advisor, right?
Jean, concerning remortgages, typically at that point it doesn't matter, Jean, because whether it's your home or another property, you're looking at a maximum of 80%. And depending on if it's a commercial property, you're not going to get 80. It's got to be under residential is going to get you that 80. If you're into the 5-6 units, you're looking at maybe 65, 60, 65, depending on the institution. Do you want to add anything to that, Tark? Okay. So it really doesn't matter at that point, Jean. And they don't. What they do check, Jean, is what's being reported, right? Again, it's up to you. It's up to you to. Yeah, they visit an appraiser visits the property, John. But this is in a remortgage. It doesn't matter. In a remortgage, it's the purchase to avoid paying 20% down. You have to take advantage of obviously the first-time home buyers. Well, it's not even first-time home buyers. 5% down, personal residence. What Tarek's saying is that we can do that up to 4 without really creating a problem with an institution. So the appraiser doesn't, it doesn't matter to the appraiser. The bank is going to know how many properties you have. They're going to know because you're going to report to the bank all expenses, right? This is what I pay. So they're going to know, what it is that you have and what you're paying for. And there's nothing wrong with that. Let them know. What Tarek's saying is you can tell them it's a resident. It's a resident.
In terms of Jean's question, I've never gone out to see a property on behalf of a client, and I don't know anybody who has. So that's the job of an appraiser. The mortgage broker or the lender or the financial advisor, that's not their job to go out and actually do the assessment or the appraisal. So we'll just go by the once we get the appraisal in, we look at that and we send that to the guys upstairs, and they take it from there.
The real thing, I mean, you should be transparent, obviously, on how many properties you have. Whatever you're paying for, you should let them know. The question that really is in contention is this your residence? And that's the question that you have to decide how you want to handle that. What Tarek's letting you know is 4 is pretty much okay. The B lenders will let you do 4. The A lenders will let you do 2, maybe 3. But there's a lot out there that we can do that we really don't know because of lack of, talking to somebody who knows what they're doing, who has the experience to be able to do it. Does that make sense to everybody? Any questions on any of that content so far?
So for example, my client who's got 2 homes, the one in Windsor and the one in London, if he wanted to buy a 3rd home in Muskoka and it's cottage country and it's for,
no problem,
vacation purposes, we'll do the mortgage from all day. His credit supports it, his income supports it. Now, if you bought 3 semi-detached in London, Ontario, it's a different story. They're gonna ask some questions, right?
Yeah, that's questionable.
And if you can, give them the right answers, they'll do it all day.
Again, they're asking those questions for their protection that they asked. Does everybody understand that? Do you remember we talked about having a couple different mortgage brokers, one that's really, really creative and one not so creative? And the really, really creative guy is going to get you pretty much anything you need and want, and he's going to tell you what you need to do and what you need to say to get that mortgage. The non-creative guy is going to be valuable in the sense of potential lease options, rent-to-owns, because he's not going to get people qualified. They're going to have a down payment, they're going to have income, but they're not going to have the credit. And due to the lack of, I don't know if it's creativity, I don't want to judge anybody too harshly, but it's for them, it's black and white, and they just decide, they're not going to get you approved because it's going to take a little bit more work. And you can tell this with the creative guys. They're willing to hustle. They're willing to make a deal happen. It's fun working with them. So it's great to have someone like Tarek on my team. Working together with him is great. He's been able to, get things done. So that's the advantage of having the creative guy. Any other questions or anything else? No? We good?
We got to get to the TDSR.
Yeah. TDSR, okay. Second thing. Okay. So go ahead.
Yeah, so once you pass this first threshold of the GDSR, so the 32% of your gross income,
right?
The next, kind of threshold you need to cross is the TDSR, which is your total debt service ratio. And in that one, they include everything from this first one, so your property tax, your mortgage.
42.
Yeah, it's 42.
42.
And they'll go up as high as 44, depending on the deal and the lender.
As 44% of your income can be taken up by debt.
That debt is credit cards, lines of credit, loans, car payments, anything that, anything that's a reoccurring type of credit. We're not talking about groceries, we're not talking about hydro, we're not talking about your garage or cell phone bill. We're talking specifically lines of credit or credit facilities. They include credit cards. They don't look at overdraft, but credit cards, loans, lines of credit, secured and unsecured, car payments, leases, things like that. When it comes to your car payments, we actually use the car payment as the payment. When it comes to things like lines of credit and credit cards, it's usually 3% of the balance.
And there's lots of things we can do there. If we're not meeting that requirement, we just ask, what do we need to do? And you might be at 45, 46, 47. What needs to be handled or managed? And that's, again, we're going to get creative. And if we have to pay down some debt temporarily to get the mortgage approved and then deal with repayment of that monies or where we got the money from, we can do that too.
Something else that's very important when we talk about your mortgage payment. So if you don't have a property or you're looking to buy a second property and we're trying to calculate that mortgage payment, somebody who's getting into a 5-year fixed mortgage pays one amount. Somebody who's going into a 2-year, 3-year, or a variable mortgage pays a different amount.
True story, yeah.
The thing that you have to pay attention to, though, is this. So if I'm going in for a variable mortgage, they're going to qualify me at a much higher rate. So if today's variable rate, for example, is, let's say it's 2.5%, and the actual mortgage payment on a $100,000 mortgage, let's say it's $700 a month, which is the actual payment. For the purpose of this ratio, they'll use a much higher rate to qualify you. So they'll actually use the bank rate, which is closer to about 4.5%. So at 4.5%, your monthly payment's closer to about $1,000 a month. Okay, so for the purpose of the ratio, they're going to use $1,000 a month, even though the actual monthly payment will only be $700. They'll use $1,000 for the purpose of the ratio. The only time they will use the actual mortgage amount is if you're getting into a 5-year fixed. So if you get into a 5-year fixed mortgage and the monthly payment's $1,000, they'll use $1,000 in the ratio. If you're getting into a 5-year variable and the payment's only $700, they'll calculate it at 4.5%, which is the bank rate, and that could be $1,200 or $1,300.
Yeah, so typically it's going to be beneficial to be in a fixed rate. It's going to be a little bit lower, and this is a question of cash flow, right? The banks are looking at cash flow, so in a variable rate, the cash flow is variable, right? That payment is variable, so they're taking into account the change in interest rates. In a fixed one, they know exactly what it's going to be for the whole term, the 5-year term. Therefore, they can say with confidence, look, this is the rate, this is how much this person's paying.
So somebody who doesn't get approved at a 5-year variable or even a 4-year fixed might get approved at a 5-year fixed. All right. So when you're doing your mortgage, when you're doing your calculations, because you've got these numbers now in front of you, you can do your own pre-qualifying. Basically, you need to take that into consideration, right? So when you're determining the mortgage payment, I mean, you can go to a mortgage calculator and get the actual payment, but when you're doing the ratio, they may not allow you to use that actual payment. So for the purpose of the ratio, always, when you go to the mortgage calculator, always use the 5-year fixed, because the actual payment will be the amount that's used in the ratio.
You can be confident that's the number they're going to use.
Right.
And if it approves that, you have a high probability of it getting approved by them.
Now, not to confuse anybody, but I've done deals myself where a client wants a 5-year variable, does not qualify for the 5-year variable, does qualify for the 5-year fixed. So because of that, what we've done in that case is we actually asked for an exception. So we asked the underwriter just to make an exception. You know, the client's got good credit, the client's got good income, doesn't qualify for the 5-year variable, qualifies for the 5-year fixed. Grant us an exception to give him the 5-year variable, and they'll do it. They don't do it on every case, but if the deal makes sense and the credit's there and the collateral's there, you know, they'll do it for you.
This is what Tarik's sharing with us is the understanding that these are rules that they make up, and they can modify those rules, based on circumstance. So these are not laws they're dealing with. These are rules made up by the bank based on their credit capacity and their ability to issue these loans.
So the mortgage broker or the financial advisor or the person at the bank, you know, he sends the deal to an underwriter. The underwriter has to look at it. The underwriter needs approval from CMHC if there's insurance involved. If there's not, he's got his own criteria that he has to kind of pass before he approves it. But at the same time, there's a common sense aspect of the deal. So it's not just numbers in a computer. You know, there's a human being reading the notes. There's an advisor making a case for this file that he wants to get approved, and if they both work hard enough, you know, they'll get the deal done as long as it's not too far off. I mean, if somebody's got $5,000 a month of income and the mortgage payments with credit cards are $4,000, you know, now you're 80% TDSR, then, you know, it doesn't matter who you go to. Nobody's going to be able to get that deal approved, right? But if you're close, you know, within 5 to 10%, chances are you'll get, you know, if you work hard enough and you find the right advisor and the right underwriter, they can get the deal done.
Okay.
So don't be afraid to ask for exceptions. Even if you're at the bank and they say, well, we can't approve you for this, but we can approve you for this. Well, can you give me an exception? You know, maybe you're a good client at the bank. Maybe you've got other assets with the bank.
Does that make sense? In which scenario is it better to get into fixed versus variable? That's a great question. The dilemma or challenge with that is really about you and what you think. Obviously, there's a little gamble with the variable versus fixed. In my opinion, I'd rather have the fixed. Tarks let us know that fixed is going to be a better cash flow situation for us and higher approval rates, probability based on that typically. But for me, I like the fixed over the variable just because, especially now with the rates being so low, there's not a lot of advantage.
The spread between the fixed and a variable now is
negligible.
You can't justify getting into a variable. Now, if the spread's 1%, it's a different story. And there's been times where the spread between a 5-year fixed and a 5-year variable has been, 75 basis points or even 1%. And in that case, sometimes
you can consider it.
It depends.
It depends. On a $100,000 loan, the 1% makes up $1,000 per year, at least in the first year, and then it's going to be a little bit less over time. And over time, that can accumulate. It's really about what you're comfortable with. And when you get into rates, and I know nobody remembers because it's been so long, but when you get into rates, where it was 8, 10, 6 even. It was more than a point difference between the variable and the fixed, right? Because there was space, enough to do it. Now they're too close to zero, right? So there's not a lot of room there. So again, that would be based on what you feel good about. Fixed obviously is going to be something that the payment's going to be the same. Anything else you want to add to that, Tarek?
No, that's pretty much it. I mean, if you guys can Google the 5 C's of credit, and the GDSR, TDSR, you should be able to pre-qualify yourself in every deal, right? You should become that proficient. It really is that easy. Just you got to know the numbers. You got to know what you're working with.
So anyone that would like Tarek's email, he can actually send you the breakdown of that if you'd like. Would you like that? He could send you the breakdown of how what they look at versus credit. Okay, so this is what I'm going to do. Tarek's going to type in his email. It's up to you. Just grab it. You can grab it, but go ahead, Tarek. Write that email in there, and you can give it to everybody.
Shift. This shift, yeah.
Okay. Got that? Is that right?
Yep.
Okay. Just press enter. There it is, folks. Okay, so everyone can grab that email. And what I'm going to do right now, actually, give me 1 second. Let me grab the recording from last week, okay? It's today. You're welcome. Oh, hold on one sec. I'm just grabbing the recording from last week. Hold on one sec. Okay, you can grab the recording. Can someone test that for me? Just open it up. You should be able to read it. Yeah, Paul, I'm having trouble with that one. Let me, I'm still working on that one for whatever reason. No worries, my pleasure.
Sorry if I was talking too fast earlier, guys. Just feel free to stop me if I go on a tangent there. But it was nice talking to everybody tonight, and feel free to email me whenever you have any questions.
Just before you go, Tarek, if that's okay, can you spend some more time? Is that okay?
Yeah, absolutely.
Okay, good, excellent. I wanted you to talk a little bit about creative financing in the private money area. What kind of stuff that you work with and you could do in the private money. So I know that. Go ahead.
Okay, so in terms of private money, obviously I've got relationships with various mortgage brokers here in Ontario and across Canada, and depending on the region, depending on the mortgage broker, most of the ones that I've come across, just to be straight up with you, they want to see the client have some skin in the game. So if you're going to be doing a deal, they don't want to do 100% financing. Most of them want to see at least 5% down. So if you want to do a line of credit on a home and you don't want to go through a traditional mortgage, they'll go past the 80% threshold that the banks can't go past, and they'll go 85 and 90%, and in rare instances they go even as high as 95%. But they want to make sure that you've got skin in the game, because they want to make it hard for you to walk away from the deal. Like, I mean, if you've got no skin in the game, what's the incentive for you to stay at the property or work on the property or do what you have to do, right? So if you've got money invested, then it's just going to make it easier for them. It's not, when you're dealing with private lenders, it's not their money that's being put up. So, a private lender here in London, Ontario, for example, you'll have a bunch of retirees with $300,000-$400,000 in their RSP, and they'll give the agent access to the funds through a syndicated mortgage, and they're expecting their guaranteed return of 6, 8, 10%, but they want little risk as well. So because of that, 99% of the guys that I've come across, they want to see you put some money up. Right?
Now the difference here, working with the guys that Tarek has been working with, is there's no fees or points up front for you to get that loan. Do everybody get that? So the difference, because you're putting a little bit into it, 5 or 10%, and you can get creative with that and find the money somewhere else. It could be credit, could be a line of credit from a house, could be something. They just want to see something. Again, it's like a rule that they like to do, that you have some skin in the game. Could be a private investor, could be anybody, as long as they see some sort of money coming into the deal from another source, specifically into that deal. That makes them feel better about it. Because of that, they're not going to charge any fees or points, and that's a big deal. That's a big deal. So you don't have to worry about paying an extra 3 points up front. You don't have to worry about an application fee typically, unless it's commercial. You're good to go. So that's the advantage you gain by working with the guys that Tarek's been working with in the private money area. Okay.
One other thing I want to touch upon, and Hyson just reminded me of this. One thing that we forgot to discuss is the source of down payment itself. So when you're putting up a down payment for a property, the lenders are expecting it to be your money. So they want to see where the money came from. So they're going to want to look at your bank statements for the last 3 months if you're putting a down payment using your own money. If it's from the sale of another home, they'll want to see the statement of adjustments, so the closing details. If it's a gift from mom, dad, brother, sister, cousin, uncle, that's fine as well. They'll want a gift letter signed.
Sure.
And this doesn't come from the lender. This is a requirement from from the government for money laundering purposes and terrorist activities and things like that. So they always want to see a paper trail. In the case of the private lender, he doesn't care and doesn't ask where the down payment's coming from. So if the down payment came from a credit card, if the down payment came from mom and dad or whatever it is, they're not going to ask. They don't care.
That's a huge advantage. So the money itself could be an investor, could be another loan somewhere else. As long as that money is in your hands, they're ready to move on that property. Does everybody understand that?
John, just the 5-10% of your own money, they don't charge any fees. I think the fees that Sam is talking about is the upfront fees. So typically with your private lenders, there's the rate 6, 8, 10, 12%. There's their fee, which can be anywhere from 0.5% as high as 2%. And then there's there could be other administrative fees and paperwork fees and things like that. I think what Sam was referring to is an application fee. So to get a deal approved, they charge a fee. Well, the guys that I work with, there's no fees involved. I mean, there's fees involved when the deal is approved, but there's no fee to get an application submitted.
Right. Unlike Vivian's working with someone in Montreal where they're asking for an app fee, which is not crazy either. It's not something that's not done in the industry. But in this case, for residential, they're typically, the guys that he's working with, Tarek's working with, they're not going to ask for a fee. What they are going to ask in lieu of a fee, in lieu of points up front, they're gonna want some skin in the game. They don't care, again, what Tarek said. They don't care where the money comes from, which is awesome. They just want to know that the money, some other money or source of money that's in your hand is being invested in the property. Yeah. So application fees, you're not typically going to see them in residential. You're
going to see them on commercial.
Yeah, you're going to see them on commercial because it's a much bigger process. It's a much bigger process. So okay, let's slow down here. Let's read some of these. Okay. So are you guys would they investing in France? Would they be open to that, Tarek? Okay, no, okay. Sorry, Frederick, no, they won't want to invest in France. But I'll bet you there's lenders out there that would. I'm currently looking for a couple places here. Okay, that's good. So you have a 5 or 10% of your own money. They don't care where. They don't charge any fees. Yeah, typically, Jean, they're not going to charge any fees, as we said. And what's great is they don't care where the money comes from. That's huge. Or some other fees. Is there any other fees that you want to mention, Jean? Tarek? Any fees that would be associated? No, it's the processing. It's more of a private loan versus a straight hard money loan where they're going to charge you those fees and costs because they don't care if you have skin in the game. They're going to make some money up front. Yes, but the private lender's interest rate is very high. So Vivian, just to give you some range rates right now. Do you have some?
Yeah, I mean, I've seen them depending on what the deal is. If it's a construction mortgage or a refinance, I've seen them as low as 6. I've seen them as high as 12. It depends on the private lender himself. And then Sergey and Kitchener, 3 months in the bank. Yeah, so they're looking for 3 months bank statements just to see that down payment was either saved using your income, and they need that just to satisfy the government basically.
Legislation. That's legislation. So Vivian, would you guys be open to Montreal? Quebec
Well, their offices are all across Canada.
Okay, so good. So Vivian, if you want, you can reach out to Tarek and he can see what he can do for you as an option.
Yeah, I mean, if the only time I'll go to a private lender is if I exhaust, the tier 1, 2, and 3 channel. Right?
And I'll tell you something, everybody here. We've talked a lot about creative financing, hard money, private money. What's great about Tarek is he can look at your current situation and see if he can make something happen first. He's going to look first a more conventional method of doing it. He's going to look outside if he needs to. He's extremely creative. I can't push that enough. The people I work with, that's the key.
And a lot of it has to do with knowledge as well. So there's programs out there available. I'll give you a good example. I have a hairdresser who has a basement salon and claims very little income. So hairdressers, construction workers, business owners, they typically declare low income. Well, the lenders aren't stupid. They understand that these people typically can make, a hairdresser, for example, out of a basement typically can make anywhere between $50,000 and $80,000 a year.
Large cash portion. Yeah.
So even though she's showing $25,000 or $30,000 of income, there's programs out there where, for income verification, they'll just take your word for it. So there's just a declaration that you sign. You indicate how much you make. You provide them with some bank statements that resemble that maybe there is that much income, but it doesn't have to necessarily prove it. And as long as it's reasonable and you've got 20% down and good credit, they'll approve you.
And they want to give you the money. Remember, they're looking for a way. And these questions they ask are, and declarations that you sign, it's to protect them, not you. It's really for their protection.
So if anybody wants to just Google Alt-A deals in Canada, that's a program offered by Genworth, which is the competition to CMHC.
Can you type that in?
Yeah.
We're going to type that link in. Hold on.
A program. Genworth.
Just Google that.
So Genworth is the other major insurer here in Canada. So if CMHC doesn't want to do the deal, or if you want the lender, lenders can typically go to either one of these. And there's a third one now as well. I think it's called Canada Assure, and they're even less restrictive. So CMHC being the most conservative, Genworth in the middle, Canada Assurity, I believe, is the least restrictive. Anyways, so Genworth has a program for self-employed individuals. As long as your credit's good and you've got 20% down payment, they're not going to look at your notice of assessments for income verification. They'll just take your word for it, but it's got to be reasonable. You can't be a construction worker claiming you make $200,000 a year laying brick. If you're a salon owner, you can't be making $250 a year. That's not reasonable. But if you're on your notice of assessments, you're showing 20 or 30, but on the form you're claiming you make 60 or 70, that's reasonable because many people in the industry make that type of money. So as long as it's believable, then depending on the lender, you'll get the deal approved using Genworth.
Me and Tarek have been talking recently about the trends in financing and money, and it seems that they're starting to get creative and loosen up on restrictions on getting you the money. They're trying to find creative ways to get you money, is what's happening, because at the end of the day, they don't make any money unless they lend money out. So they're starting to, really at the end of the day, they're starting to take more risk on. That's what it comes down to.
And because they're taking on more risk, so for example, with the Alt-A program offered by Genworth, the insurance company, your insurance fees there's a fee for that, right? So they're not as high as the CMHC fees on a 5% down payment. Because you're putting down 20%, the fees are minimal, but there is still a fee, right? Whereas if you put down 20% with a traditional lender, there are no insurance fees because you're not getting insurance. With 20% down payment, you don't require insurance.
Right, because the 20% creates the buffer for economic change, right? If the market changes, they don't need to insure that loan because the idea or the speculating that the market's going to drop 20% in that 5-year term period, it's very rare. So they're not worried about insuring that loan.
Well, what'll happen is the lender will still get the insurance, but they'll pay for it out of their own pocket at a much reduced rate. Yeah,
internal.
Because they want the insurance, right?
Yeah.
But you're not paying for it out
All
of their
of them,
pocket.
everything, right? Yeah.
Pretty much.
Yeah. And they sell that bond. That bond goes to the bond market. Those are all. That's where the mortgage rates come from, bond market. So, how much does it cost them to attract new money? And that's why at this point, for them to attract the money and start using that money, getting that money out, and continuing to grow in their profits, we're seeing a trend of these of loosening and taking more risk on, just a bigger appetite of risk.
Well, if you're putting down 20%, there's no fee. There is no insurance fee. If you're using that Alt-A program through Genworth, there's going to be a minimal fee.
Thanks, John. John's put up the link that straight to the Genworth. And again, we don't want to necessarily, I don't want you to worry about trying to get out the fee. Get rid of the fee or avoid the insurance. When it's appropriate, it's there. Just accept it. It's more of a, it's a rule that we deal with when we're under 20%. When we're in that 5%, we're definitely getting it. Don't worry about it. It's nominal, right? At the end of the day, we want to let the numbers tell us what to do, and if that's part of the deal, then it's part of the deal. Yeah. Tar, can you talk a little bit about seasoning? So if I get how does it work when we get private loans with a property? Typically, what do the banks like to see in time frame of seasoning before I refinance? Just give me 1 second. Read that.
Talking about something though.
So yeah, Tar, go ahead.
So one other thing I wanted to mention, just incentive for the seller. Always ask if the mortgage is assumable. Sometimes,
excellent question.
Yeah, sometimes the person selling the property has an assumable mortgage, and why that's advantageous is if you can assume that mortgage, then you're basically saving the client a bunch of penalty. And if he doesn't have to pay that penalty,
that goes into
that can reduce the purchase price for you, right? So always ask, is the mortgage assumable? And then what you could also do is you could assume the first mortgage, and then you could, borrow some additional money, blend that new money with the old money, and then you've got a blended mortgage. Another thing I wanted to mention is you can port your mortgage. So if you've got a mortgage on one property and you're selling it, and you've got another property that you want to buy within 120 days, you can pick up that mortgage and drop it at the new property, and then just, it'll either be a port with an increase, so there's additional money being borrowed, or a port with a decrease. If it's a port with an increase and you're borrowing more money, there's no penalty. If you're going to port it over to a new property and there's a decrease in the mortgage, let's say the house is 100 and you've got a $200,000 mortgage, then you're going to pay a bit of a penalty because you're borrowing less money.
This is very important. So
mortgage porting and assumable mortgages. Those are two things that you need to know. Portable.
Porting. P-O-R-T.
And then the first one was
assumable. Porting is taking a mortgage. Yep, portable. So taking a mortgage, you sell your property. You, instead of breaking the term on the mortgage, you port it to the new property. A new property within 120 days, basically 3 months. So we bought another property. Instead of breaking the mortgage, paying the penalties, and getting a new mortgage, we can just move that mortgage over. Tarek's letting us know that if that mortgage amount, say $100,000 I'm bringing over, yeah, it's great. $100,000 I'm bringing over to this new property, but this new property is only $50,000. Well, they're not going to give me the $100,000 mortgage. Typically, there's going to be a penalty involved because it's a reduction against the actual asset, the new house. Now, if the new house is a $200,000 property and I'm bringing over $100,000, not only will there be no penalties, there'll be an opportunity to add additional a mortgage to it, and in some cases create a cashback scenario, right? So what Tarek's talking about now is something that is important for you to understand. But to the point where you're asking these questions and then working with your broker to deal with it, right? You want your broker to understand these things, because that creativity is the difference, between making an extra, could be $5, $10, $15, $30,000.
Well, that too, and you want to make sure that the broker is honest, because you're going to come across a broker who doesn't mention the fact that your existing mortgage is portable, right? So the fact that you can port it over to new property, I mean, if you do that, he's not making new money. He's not making a commission. So they may not tell you that, right? But every mortgage that you have with a traditional lender is portable. You can port it over to a new property, and you can port it over with an increase. You can port it over with a decrease. And if you've already paid CMHC fees, the last thing you want to do is pay a new set of CMHC fees. So those fees follow you to the new property. So they're paid on this new property. Now, you may pay a top-up if there's new money being involved, but those are still advantages for you. The other term that we talked about was assumable,
right,
meaning you take over the existing mortgage. So if I've got a mortgage on my property and I'm selling it to Sam, Sam could take over my mortgage.
Which is huge.
He'd have to qualify, but he could just assume it.
Yeah, so because the mortgage is already there, instead of breaking the mortgage, which is typically a 3-month penalty versus 3 months interest or interest differential penalty, that could avoid those penalties. And on a serious property, on a large property, that could be anywhere from $10,000 to $20,000 to $30,000, even $30,000. That could go into purchase price, right? That could be a negotiating tool that we could use to be able to do that. It goes with a different owner. Yeah, so it's when you're assuming a mortgage, someone else is assuming it. It's a different person. Portable mortgages are you're the same person, you're just moving the mortgage from one property to another property.
Yeah, so you pick up your existing mortgage from property A and you move it to property B. Assuming a mortgage is taking over the existing mortgage at that property.
And as Tarek was saying, it's more common. What's it say?
No, you do have to qualify when you're assuming someone's mortgage.
Yeah.
You still have to qualify. All that criteria.
Same requirements are still going to be there. But what we're looking for in the assumable is the avoiding the fees of breaking a term mortgage, right? And as new CMHC fees, new fees attached to it, everything carries over. As well as with portable, there's a CMHC insurance policy on that loan for the lifetime of that loan. That CMHC comes with it, right? The loan that it's insured, the insurance comes with it.
Right, and as well with assuming a mortgage, I mean, let's say for example the property is worth $300,000. Okay, let's say deflated for whatever reason. Let's say the mortgage is $300,000, the existing balance of the mortgage is $300,000, and the property is worth $300,000. You could assume that mortgage with no money down.
That's right.
Now, typically what happens is, if you're going to assume a $300,000 mortgage, the property is worth $400,000, there's going to be some sort of down payment required to get you up to 95%.
Right. Everybody get that? The difference, yeah. Okay, we're going to say this a little slower.
Okay, so if you're going to assume a mortgage, so let's say, I'll make the math easy. So I know a builder who built a bunch of townhouses here in London, Ontario. A bunch of people bought them at $100,000 or $115,000. My apologies. A few years later, market went down a little bit. These townhomes were worth $100,000. Somebody sold their townhouse. They sold it for $100,000. The balance of their mortgage was $100,000. Client walked in, assumed that $100,000 mortgage, qualified for it, didn't have to put any money down. He bought the property for $100,000. So he basically just took over that person's mortgage.
Everybody get that?
So the person walked away, the person selling the house walked away without making any money. But he needed out of the property. He got a new job. He needed to relocate. So he wanted to get out of his mortgage. So somebody just assumed it.
Okay, so let's look at the scenario where that same $150,000 property, the property dropped to 95, but the mortgage was 100,000. In other words, they're upside down on the mortgage. When we assume that mortgage, Tark, what happens in that case?
Well, you're still assuming it at whatever the balance is.
100,000, right?
Whatever the balance of the
But
mortgage is.
right. So will the bank ask me to put in an extra $5,000 to make up that difference because the house is only worth 95? What will they do in that
No,
situation?
you're just taking over the
So they'll let
mortgage.
me come in as long as you're assuming the whole amount.
That's correct.
Okay. So what if the properties went up and
So-
it went up to 200,000?
So if the property went to $200,000 and the person selling the house is selling it for $200,000.
Yes.
But the person selling the house is 1 year into a 5-year mortgage, he'll advertise that the mortgage is assumable. The advantage for the person selling the home is that he doesn't have to pay fees to break his mortgage. So now I'm the client. I walk in there. I'm buying the property for $200,000. I'm going to assume the first mortgage at $100,000, and then I'm going to get new money for the other $95,000. So I'll have a $95,000 second mortgage with another lender, or with that same lender. What I'll do is we'll blend two mortgages together. So we'll take the assumable mortgage, that's $100,000, and we'll blend it with new money at $95,000 at a different rate.
We have to because the mortgage, right? Unless you're going to come up with the other 100
Yeah,
grand,
if
right?
you've got the other $100,000.
Yeah. This is a question of the bank saying, look, if you can assume, take what you want with the assumed mortgage. We're going to have to make up the difference, though. The difference has to be made up if we want a small down payment, depending on that down payment. So the owner, okay, this is something I've learned.
So
Don't worry about why people do what they do. If it benefits you, great. We want to know motivation to solve people's problems. But in this case, a guy selling, in this situation where the market's sliding downward in an area, he was more than happy to break even. Because obviously there's a fear that it could continue to go down. Could have been that he got married and he wants to buy a bigger place. Could have been, there's 100 reasons. Work, job, it's so difficult to say. The more important point, I think, is recognizing that there's an opportunity to get into in a conventional way, really, to get in to a property with no money.
So for Justin's question, how would it look if the seller has equity in the property? So if the seller is selling the home, so let's say the home is worth $200,000 and he sells it for $200,000, but the balance of that mortgage is only $100,000. So he would still sell the home for $200,000, but what he's telling the new owner is, hey, you don't have to go out and get a whole new mortgage for $200,000 minus your 5% down payment. I've got this $100,000 mortgage. It's assumable. Take it over, and I'll reduce the purchase price by the penalty.
Yeah.
Or a portion of the penalty.
Yeah, to make it more attractive to the buyer.
Yeah, because the guy who's selling the house, maybe he's not porting his mortgage over to a new property. Maybe he's leaving the country or leaving the city or for whatever reason. If he's leaving and he doesn't want to pay a penalty to break his mortgage, he'll advertise that it's assumable, and the new buyer can take it over. That doesn't mean he's not going to get the rest of the equity from the home. If he's selling it for $200,000 and the balance of the mortgage is $100,000, he's still going to get his $200,000.
He's getting paid. The new owner, right, has to decide. It's a $200,000 property. I can assume a $100,000 mortgage. Am I going to put $100,000 cash down to buy this property, or am I going to get a blended mortgage or a second mortgage on that property that's going to bring me up to that 5%? So we'd need another $90,000 in mortgage, 90, 95, depending on who you're working with, but 90, putting the 5% down. So I only have to put $10,000 in. Does everybody understand that example now?
And then just John for so no debts for him, but no profit either. No, John.
No.
So if they're selling the home for $200,000 and he only has a $100,000 mortgage, and let's say he bought the property for $150,000, he's still making his $50,000 profit. All we're doing there is the previous owner is just saving some penalty by letting the new owner assume the existing mortgage.
Yeah, he's not losing. Nobody's, whatever you sell your house for, you sell your house for. This is what's underneath it in the way of mortgages and equity and stuff. At the end of the day, what you sell it for, you get. Whether that's a loss or a gain, you're getting that money, right? That's the deal. What we're talking about is what can we do with what's happening already. There's a mortgage on it. It's assumable. Let's see if we can do something creative to reduce the initial cost of this property, right? Because we're helping the guy out too, and you could split that, right? It could be a split. The penalties were $10,000. What he's going to do is he's going to take $5,000 off the purchase price, if you qualify for the assumable mortgage, right? The other exciting thing that Tarek talked about was porting, right? Porting that mortgage over to avoid breaking a mortgage with the fees there. Also create possibly an opportunity when you're assessing, the cost of that move or the acquisition of the new property. What's most exciting, I think, is again Tarek sharing it with us the idea that with an assumable mortgage, you could come into a property and put no money into it, and it would be totally legitimate and totally accepted by the lenders, right? You just got to take over the whole mortgage. That to me is probably the most exciting about it. And the idea that assumable mortgages, the frequency in the marketplace for those contracts as a mortgage.
So in a situation, I'll give you a perfect example. So these new condos that are being built in Mississauga, a friend of mine put a down payment on one a year ago. I think the purchase price was $550. In the spring of 2017, they were valued at about $600, $625. Shovels haven't been put in the ground yet. These are scheduled to be built spring of 2018. So now he bought it for $550. In the spring of 2017, it was worth $625. By the end of the summer, these things are now worth $500,000. So here's a situation where a friend of mine.
Everybody get that? Wait, everybody get that? These are pre-builds. Remember we talked about this. This is the risk. This is the risk.
So here's a situation where a friend of mine bought a $550,000 condo in Mississauga.
What year was that?
He put his down payment in 2016.
2016, $550.
They were supposed to be built winter of 2017. They've been pushed back till spring of 2018. He's already put his down payment. So when he bought it originally back in the fall of 2016, the purchase price was $550. Spring of 2017, these things went to $625. He's thinking he could sell this thing for $625, make $75,000, and be happy. But his goal is to actually live in the home. He's got a new child coming. Today, if we were to sell that same property that still hasn't been built, a shovel hasn't been put on the ground, he couldn't get $500 for it. So in the spring, there was a huge spike in real estate values in Mississauga, Toronto. Things have cooled off, and now we're seeing the reverse of that. Yeah. So here's a guy who's going to hold on to a $550,000 mortgage on a property only worth $500,000. So if he wanted to walk away from the deal and not see this loss, and maybe he thinks home values are going to continue to decline, he could walk away, and somebody could walk in there and
assume it
and assume the mortgage.
Yeah, and so the assumption, and look at the situation here where we're in a situation, and maybe not that large. We'd have to run the numbers, but maybe it is an advantage to us to assume that whole mortgage. He gets to sell it to us for a higher price than what it's valued at, but we don't have to put any money in, right? That's an advantage, right? In the marketplace, Tarek, how often are we going to see the assumable mortgage clause, that the mortgage is assumable?
Well, most mortgages are assumable.
Just standard.
Yeah, I mean, that's a standard function of mortgages. Most of them are assumable.
Right.
How often will you see somebody exercise the right to assume a mortgage without putting any money down? I mean, you're only going to see that on new builds,
right,
where home values are depreciating quickly.
Right.
And you'll see that often.
Right.
But I mean,
that's under the advice of someone else, clearly, because that's not a common thing known or understood by people, clearly. And I think that the key here is let's assume the mortgage is assumable, and let's assume that we can port mortgages, and obviously we have to further investigate. At the end of the day, these are tools for us to use to make it easier for us to acquire and sell property and to negotiate.
Yeah, and to negotiate. To save you in fees with your bank.
Yeah, the fees are huge. I mean, on a $1 million property, I mean, or even $500,000, you break those fees, depending on that interest rate, you could be talking 20, 25 grand easy, on those fees if you're breaking the term.
One other thing I wanted to mention, if you're with the bank, when it comes to renewing a mortgage, so let's say you're in a 5-year fixed mortgage and your term is up, the renewal is a signature. You could be on the brink of bankruptcy, your credit to zero, and be $100,000 in debt. On a renewal, you just sign and you're good to go. There's no income verification, there's no credit checks. So that's some of the advantages of staying with your bank. And then also the ability to port your mortgage. So if you're going to be flipping properties, the best thing to do is you pick up a mortgage, you get it once, and you just keep pouring it from one property to the next. This way, you're not,
constantly breaking it. The other
You're
option,
paying
yeah,
fees
yeah,
and-
yeah.
and
The other option
having
is
to
you got to go
qualify.
variable. The only way to do it is to go variable. A variable loan, and as Tarek said to us, the requirement is higher for a variable loan because the cash flow is requirement's going to be higher, even though you might be paying a lower amount at the time, right? Because they're trying to make sure that they don't get interest rate spikes and then be on the hook for default.
Let's just look at some questions here. Wait, that's as well. The interest rates, right?
That's right. Yeah.
So if you're, so right now, for example, rates have gone up, right? So there's incentive to assume people's existing mortgages. So could you imagine if the Bank of Canada increases the rates another quarter point in the next rate decision, and let's say a year from now we're up 1%, and you've got
That's
all
massive.
you've got all these 5-year mortgages that are 1 year in with 4-year terms left that are at 2.25%, 2.5%, 1% less. Think about how attractive those existing mortgages have become.
And that all can be calculated into a value, right? And that value can then be put into the price. This is great stuff to know. So in that question, Rose, what Tarek was saying, yeah, you're going to assume the 550 because the mortgage was was it 550? Put something down.
He put down his 5%.
How much? 5%. So you'd be assuming what 525, right? Then about 520. Yeah. So his mortgage, the existing mortgage was about 525. The value of the property is 500. So he's upside down. Typically, that's not going to trigger anything or be a problem because he's going to make his payments and he's going to continue to do what he does. But if you came to him, Rose, and you said, "Look, tell you what, your property is, you want your property is the mortgage is 525. You originally had it at 500. It's 525 is the mortgage. The value is 500. I'll pay you 525 if we can assume the mortgage. If I can assume the mortgage and take that mortgage over, guess what? I'm going to get you out free and clear. That's a huge advantage. Now, the huge advantage for you, Rose, is there's no deposit. There's no down payment. That works for both sides.
One other point I wanted to mention, if we're talking about cash flow, the maximum amortization you can go on a mortgage is 25 years. Right?
Insurable. Can you repeat that just so let's hear that again. So listen up. This is very important.
The maximum amortization on an insurable mortgage is 25 years. The maximum amortization on a secured line of credit, well, there is no amortization. So, technically, if you're able to go to a lender and get a secured line of credit versus the mortgage, because you've got your 20% down. Now, the rules have changed a little bit. So what they're going to do is they're going to give you 65% loan to value, and then they're going to amortize 15% over a term. But that other 65% in a secured line of credit, all you're paying there is interest. There is no principal. When used. Right? So if you're using those funds to purchase a home, because you don't have to use a mortgage to purchase a home, you could just use a secured line of credit from the get-go.
Because it's the same cash, the same as cash.
The rate's a little bit higher, but you forego having to pay principal. So if you're looking for positive cash flow and it's not positive cash flow with the mortgage because you're making principal payments, try using a secured line of credit and see what changes.
Absolutely.
What happens with the cash flow.
Yeah,
because if you're only paying interest, there's 50%, typically there would be 50% more money go in your pocket on the deal.
Yeah, it's similar to when we put an offer out with a VTB, vendor take back. We always want to ask, can I pay interest only? And we'll pay even a little bit more because we're trying to maximize cash flow. It's an excellent example of that. Okay. Any more questions? We're wrapping up. I know that we didn't get to look at any deals. If there's any questions, last minute questions that we can answer, those people who sent me. Anybody that sent me anything, I'll review it and I'll get it back to you in the next couple of days. I thought we were going to do it here together, but we ran a little bit longer than an hour. So I just want to answer. I want to answer any questions that we can do right now. Okay, we won't be looking at properties tonight, but I'll definitely get back to you on the properties that you've sent me. And do we have any questions or anything? Vivian, are you good? I know you sent me the one about financing. Is there any questions about that? Thanks, Tarek, for saying thanks.
Oh, you're welcome, guys.
Yeah.
My pleasure.
So yeah, reach out to Tarek by email. It's good to go. What question was that? Yes, the question. I'm overwhelmed with lots. Yeah, okay. So Vivian, you got his email, okay? So I really think, Vivian, you should reach out to him because you're looking at the loan right now. Okay, is there anything we could do to negotiate with the lender so they will agree to pay the insurance? Tarek, is there anything in your experience where you can do something with the lender to pay the insurance, the CMHC insurance?
No.
Me either. I've never seen it. I've never seen it, my friend. I won't say it's not possible.
Yeah, I mean, they pay the insurance if you're putting down 20%.
Yeah, that's because they're insuring themselves, right? Any
But
possibility
anything
to
less than
get a
20%?
mortgage?
No.
Okay, any possibility to get a mortgage for a newcomer to Canada with no job? Yes, Franklin, yes.
There's programs available for immigrants.
Yeah,
As
and
long as they've got assets back in their
back home
in the country they're coming from, then yeah, there's programs available. They're hard, but they're doable.
And Franklin, also, you can look at the private money, right? If you have capital to put down, right?
Yeah, take a look at Genworth's website.
Yeah.
They've got programs there for newcomers to Canada.
If anybody's looking at, if anybody's looking for a mortgage or something right now, you're more than welcome to talk to Tarek about that, and he can see what he can do for you. I would rather, and all of you email him about the credit information and getting qualified. I'd rather you use Tarek for actual deals that are going on. If you're working with something, of course you can ask questions, but I'd rather general questions you can send to me, of course, and financing questions. If you're dealing with something real, I'd rather you can utilize Tarek. So if and Tarek, again, I know he mentioned it. Any financial advising that you want to talk to him about, you can talk to him about. That's beyond the scope that I do. That's something he can help you out with. Okay. Any other questions before we wrap up, ladies and gentlemen? Good. Awesome. If you're good, type in Y or yes. There you go. Thanks. You just fine, John? Thanks, guys. Good stuff. Good stuff. Awesome. All right. Okay. Everybody have a great night, and reach out if you need anything. And of course, if you're working on anything and you need to look at some creative financing, my good friend and team member Tarek will help you out. Okay, anything you need. Have a great week and keep hunting, and we'll get some.